Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I'm going to walk you through the process of valuing Disney stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Disney is a mass media and entertainment company headquartered in Burbank, California. The company was originally founded in 1923 by brothers Walt and Roy Disney. The company established itself as a leader in the American animation industry before diversifying itself into live-action film, television, and theme parks. The company is known for its film studios Walt Disney Pictures, Pixar, Marvel, Lucasfilm, 20th Century Studios, and there's many more. Disney also owns and operates the ABC television station, cable networks such as Disney Channel, ESPN, FX, and National Geographic. It owns Hulu and 14 Disney theme parks. Let's get started with the model. This is a large cap company, 313 billion market cap. They're trading at $173 a share, and they have 1.8 billion shares outstanding. Let's look at the financials. The way you value a company is you forecast the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. You could see they have positive free cash flow each year, but it's up and down, 9 billion to 1 billion, up to 3 billion, down to half a billion. Net income is a profit and loss on the income statement. It's revenue minus expenses. And they had negative net income in 2020, mainly due to coronavirus, but positive in the other years. And their revenue grows each year from 59 billion to 75 billion. This is the company's income statement. The top line is the revenue, the sales for the company. You can see the revenue dipped in 2020 due to coronavirus. They had their highest revenue in the trailing 12 months, 75 billion. That's mainly due to Disney Plus, their streaming service. Below revenue is cost of revenue. Then the difference between those two numbers is their gross profit. They had their highest gross profit of $29 billion in the trailing 12 months. Then below that is operating expenses. Their operating expenses are really high because they're still maintaining their theme parks even though they have low traffic. In addition, they're trying to grow and market their streaming service. So their operating income was really strong in the trailing 12 months. It was a bit low in 2020. The bottom of the income statement is your net income. That's the profit and loss. And that was negative in 2020 because of COVID. They managed to pivot the company and they had really strong revenue and really strong net income in the trailing 12 months. So the future looks really bright for this company. This is the statement of cash flows. The top line is operating cash flow. That's how much money the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. And operating cash flow minus CapEx gives you your free cash flow. And that was positive every single year. It was pretty low in the trailing 12 months. In 2018, the company paid off a lot more debt than they issued. They issued the same amount of debt as they paid off in 2019. But due to weak sales from coronavirus, the company issued a lot of debt in 2020 just to maintain its business. Let's look at a capital structure. They have $88 billion of equity, $58 billion of debt, and $40 billion of net debt. They pay 2.5% interest on their debt, and cost of debt is about 2%. And they have 40% debt in that capital structure, which means they're 60% equity. Cost of equity is 11.3%. Their beta is 1.17, so the stock is a little more volatile than the market. And their WACC is 7.5%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimate a terminal value, which is all cash flows past year 4, that's 433 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $382 billion. We divide that by 1.8 billion shares. And we get a calculated stock price of $211. They're trading at $174. So they're trading at an 18% discount. It's a buy according to the model. Simply Wall Street's at 139, so they're saying the stock is overvalued. They're saying it's a sell. I'm expecting their free cash flows to grow a lot based on their expected growth of their streaming service. And also in 2021, their theme parks should get back to full capacity. The stock was increasing steadily for about 3-4 years, but then it dropped like a rock in March. But it's really been coming up a lot, especially the past 2-3 weeks with their Disney Plus service. The company used to pay a dividend. The last dividend payment was in December 2019. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have about $52,000 today. If you did not reinvest the dividends, you'd have $49,000. And in the past 52 weeks, the company has outperformed the S&P, up 19% compared to the S&P of 14%. The 52-week low was 79, the high was 179. The stock is trading above its 50-day moving average and 200-day moving average, so it's on a major uptrend. This is a pretty liquid stock. Over 11 million shares are traded each day, and all the shares outstanding are on float. And about 2/3 of the shares are held by institutions. They have a really low short percentage. Only 1.1% of the shares are shorted. At the end of 2019 is when Disney started to launch its streaming service. Disney is trying to compete head-on with Netflix. So they banned all Netflix advertisements from any of its services. Currently, 86 million people use Disney streaming. And Disney may surpass Netflix as early as 2022. Let's look at their financial ratios. The average PE in the market's 12, the median is 14.5. PE is stock price over earnings per share. They're at 30.3, so investors are paying $30 for $1 of earnings. Price to sales is stock price over sales per share. They're at 4.2, so they're between the median and average. Price to book is stock price over book value per share. They're at 3.6, also between the median and average. And to calculate book value per share, that's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $88 billion of equity. But they have negative $13 billion of tangible equity because they have a lot of intangible assets on their balance sheet, $96 billion. Most of their intangible assets are goodwill of $78 billion. One of the risks of investing in a company with negative tangible equity is if they go bankrupt, then you wouldn't get any money. Interest coverage ratio is EBIT over interest expense. They're at 7.8, so they can easily cover their interest payments. ROE is net income over equity. They're at 12%, so they're better than the median and average. Current ratio is current assets over current liabilities. They're at 1.3, so they can cover their current liabilities. And their current assets are $17 billion of cash and $12 billion of receivables. And the company is well capitalized. They did have a small amount of free cash flow in the trailing 12 months, but that number should grow a lot with its streaming service. Also, they have $8.6 billion of working capital. Working capital is current assets minus current liabilities. The best way to look at ratios to compare them to similar companies, I've done videos on Cineplex, Discovery, Genius, and Roku, all in the same industry as Disney. And if Disney has number in green, they're better than the average. If they have number in red, they're worse than the average. So they're better than average in every single category. Price to sales, price to earnings, and price to book. They have the same current ratio as average. Their ROE is positive. Most companies in this industry have a negative ROE because they have negative earnings. They're lower in debt than average, and in terms of market cap, they're by far the biggest company. So this company has a really exciting future. I wish I would have been more on top of their streaming service and maybe bought more stock a few months ago. But I think the stock will go way higher, especially when their theme parks open up. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.